The markets just had the worst bloodbath since 2020, with over 2.4 trillion being lost overnight. Yet some strategies have silently crushed it while others have completely blown up. In this episode of Systematic Shenanigans, after trading through multiple market cycles and managing both of our portfolios, Pedmer and I will reveal the 3 critical performance metrics you need to monitor during extreme volatility, plus also the psychological traps that wreck most traders during these periods. By the end of this episode, you'll have a better understanding of when you should be worried or when you should be ready to capitalize on these opportunities. With that being said, let's get into episode 9. Okay, so the first topic I want to go over this week, we also mentioned on last week's podcast, was diagnosing performance. And I think, as we both know, this week, as currently it's the 6th of April, it's been a terrible week for pretty much all markets. BTC and ETH has held up a bit better, but this leads into the topic about how you diagnose when your system is no longer working. So at least for me, a lot of my trend following strategies performed actually really well during this period because it was pretty much, if you look at ES and Q, it was just straight down. there was only a downtrend. There wasn't really even much bounces. So if you caught the initial signal, whatever that would be for your particular strategy, mine were just very classic breakdown signals. It pretty much wrote them down the whole way. The only downside of this, and I did actually write a small email about it recently, was that I was surprisingly overcorrelated this week. And I always pride myself being that, I'm not super correlated. I have low correlation portfolio. But as we kind of all know, when these stress periods happen, everything just fades. Like I was just short on everything. And I think out of like the 10 strategies I'm running, at least on futures, 9 of them were in positions, which is very, rare for me. That actually like pushed a bit of my budgets on capital I have in my futures account. Actually, I think I'd add a small amount because normally a given week for me, I may have, well, not a given week, sorry, a given day, I may have 3 or 4 in a position, max, give or take. Normally not all of them are in a position, at least for me. But how did you kind of find this recent week? And, did you go into drawdown through it? Did you, how did you kind of handle it?
Surprisingly, my drawdown isn't that large. When I mean the drawdown, I mean from these last few days, because I'm not that allocated to equities. I'm just trading crypto, and crypto has been relatively strong the past few days compared to the bloodbath that has been equities, right? So I'm not that worried about that. I don't have that large allocation to equities, even though I hold a lot in my long-term portfolio. And I actually just bought more last week.
Fair.
Yeah, and I'll be willing to buy more in the upcoming days. I think that, yeah, this is more a conversation around around what I see for the future, But yeah, in terms of drawdowns, what you asked, it's not that much. I actually just been kind of chill for the past few days. So.
And on a small side note here, this week was very weird for me mentally because I'd made money with my futures automation strategies, but I basically lost more on my long-term portfolio. So like on the net worth side of things, it actually went down, and that was just a very strange feeling. I never had that big of a position in long-term equities back in 2020. Like I had some money back in 2020, but definitely not compared to what I have nowadays. So it's just a different level of volatility I'm having to handle, and it's like the first kind of glimpse of how 2020 would have felt if you actually had a solid equities portfolio. And still, I'm by far not 7 figures or anything in it, but it was a strange feeling.
Yeah, it comes with the territory, right? I really do believe it's like I try to separate things, my long-term things, from my active trading. My long-term, I don't mind the short-term volatility if I'm holding like quality stuff, like stocks, a diversified portfolio of stocks. If I'm holding gold, if I'm holding like a very either the top cryptocurrencies or like very high revenue generating cryptocurrencies. I don't mind like the volatility of that. Of course, I'm trying to size in my portfolios relative to that. And my active trading portfolio does hold much more like capital in it. But I try to see the long term just as it is, as long term, like 5 years ahead. I know it's hard. I'm not trying to sound like all strong and stuff like that. I'm just saying I try to brainwash myself. Like I have to see it in 5 years. Doing 5 years, do I see my positions losing money? Like it would have to be like very bad economical conditions. So it is what it is.
Yeah, I agree. I think it's a kind of underrated strat to almost brainwash yourself. You just have to be careful when you're doing it for a non-long term or like a ton of data behind that sort of decision. But obviously,
Yeah.
SPY, there's a ton of data behind it, so it's totally fine. But this does lead into the diagnosing performance side of things. So if you had, for example, a mean reversion strategy running this past week, well, at least I know from mine, they got destroyed, right?
Yeah.
And it's a very huge benefit of having uncorrelated, or not uncorrelated totally, but just different strategy types. Because my trend following made up for more and but extra compared to my mean reversion strategies. And when that goes into diagnosing performance, I think some people, if you're running a strategy and you don't understand that your strategy is a mean reversion strategy, or you don't understand the characteristics of it, you would be maybe taken off guard that you lost basically for a full week. I don't think my mean reversion strategy had like one green day this week, which is very rare. It's pretty insane, but it makes complete logical sense, and that's the key thing I'm always looking for when I'm diagnosing performance. Is there a logical reason behind this? Is it based on the characteristics? Was it based on the market regime? Has it worked or not worked in this sort of environment before? At least those are the main characteristics I look for. What about you?
Yeah, sure. And so mean reversion strategies is really a negatively skewed type of strategy, right? You have a lot of small winners. Um, they are usually very consistent type strategies, but they have a very fat or long tail to the left of losses, right? It's the opposite of a trend following strategy. So if you have two things into a portfolio, that's both things like try to cancel each other, even if not, but you know what I mean. So
Yeah.
yeah, I think that's important and something that I'm trying to improve myself as well.
And then also just for some like key performance metrics, because I always get this question on Twitter of like what performance metrics do I look at or have the
Yeah.
highest weighting to. I think it's a bit of a flawed question because realistically you kind of need to look at all of them. I think a lot of them give you a better picture than just looking at one. Obviously, if you just had to look at one, it'd be like Sharpie ratio or Sortino ratio, one of those. But a couple other ones I'm looking when I'm diagnosing performance will be normally win rate if it's a mean reversion strategy. I think that's a really good metric, at least for me, of seeing is this strategy in a very weak period, meaning that it's normally on a mean reversion strategy, you should have, depends on the market, but give or take, 60% plus win rate, normally on the higher end, right? And if that's really degrading and it's not because of the market environment, then that's potentially that signal is no longer working for that mean reversion strategy. So that's one metric I really pay attention to. And then when just looking over a general strategy, I'm looking at like average drawdown days, max drawdown on a Monte Carlo as well. And then one that isn't considered as much is trades per year. The reason I look at that one is because it helps you align with cost and commissions, and it also helps you align with how many samples are you going to get over that year for you to make decisions. So if you're running like a swing strategy and you get 20 trades per year, that's going to be very difficult to optimize when you're actually running it on a live market because you're going to need multiple years to really get any statistical significance data. How many trades do you actually take per year? Do you know?
So it depends on the model. For example, on the binary model, I run a weekly trend system. It's binary.
Yeah.
I don't know. I think I have about 200 and something trades per year.
Okay, that's not
And
bad.
yeah, and on the continuous model, now that yeah, it's a completely different model, and I don't look at trades in the same way because it's taking trades every day.
Yeah, correct. It's rebalancing, so it's not really necessarily like a signal binary on and off. So that's totally fair to look at it that way.
I was just going to add, like you were saying about the metrics, the
Yeah.
performance metrics. I would say for me, it is like more around the Sharp, the volatility that the strategy takes. So with Sharp, you get the returns for the volatility, and that's important. But if you are taking like 90% vol, that's still a very high risk strategy. So you have to think about those two metrics. And then something that I'm starting to look more into is like returns to gross exposure, so that you risk adjusted returns to gross exposure, so that you understand how much return are you really getting for this exposure that you are taking, because a strategy that consumes a lot of capital but returns less, that a strategy that consumes less capital is more the latter is more attractive because it doesn't take as much capital to generate more return, and that generally means less risk and stuff like that. So those three, I really look at things from a risk adjusted performance. Everything that's risk adjusted is what matters to me.
Are you looking at nominal value or are you looking at like margin, etc.?
Nominal.
For the second point, I think we discussed this a bit last podcast, was that a lot of trading is basically self-reflection outside of the finding the edge side of things. I put a tweet ages ago, I think it was maybe a year ago, about how I've grown a lot in personality just because of trading. And I think trading teaches you to be, in a certain way, calmer, more logical. Obviously, it removes that sort of, well, it doesn't remove, but it makes you think a lot less of your emotional decisions compared to just trying to interpret what you're logically thinking. And then the key thing for me, it was always kind of taking time back. I don't think I ever considered my state when making a decision before I got into trading. Nowadays, I'm constantly kind of seeing, am I in a state that's making me more sensitive? Am I down a lot of money and that's going to, cause me to make X decision? And then I should wait for the, tomorrow morning, for example, to make a decision and those sort of things. Have you noticed the same in your own trading journey, or has it been completely different?
No, I also notice we always like we tend to joke around about the psychology stuff, and most of what we joke around is true. But there comes a point where you have your models running, you have some side trades that you do, allocations, long term stuff. Like when you are when you like put yourself like almost remove yourself from the trading aspect, and you have to think about your business carefully. Yeah, you have to reflect a lot, know how to take yourself from your emotions, look at the market rationally. Like, for example, right now, the market is down. Everybody's like, there's blood on the street everywhere. Everyone is talking like scared of the market. And you have to look at it rationally and think, like, what can I do here? How can I make money out of this opportunity? Even though everybody's scared, even though you are losing money, you have to still like take yourself, remove yourself from that and try to think ahead, try to predict moves. I'm not saying predict stuff outside of your system and stuff like that, but you have to be able to remove yourself from everybody around you, if that makes sense. And that comes a lot from with a lot of self-reflection and experience over the years.
Yeah, completely agree. Especially if you're doing anything discretionary, self-reflection is super important because, these sort of moments where there is such extreme stress happening, and as you're saying, kind of like blood on the streets, these are normally where the best discretionary trades happen.
Yeah,
I'll definitely admit none of my systematic strategies are like taking the best trades right now. They're just they're evening out. Like I was long gold because gold was in an upward trend, but I was short SPY, and then I was getting completely destroyed on like NQ with mean reversion. So like those sort of things just all balance themselves out. But if I was a discretionary trader and I was very calm about it and I could see, hey, well, SPY is completely crashing, I could do short on SPY, long on gold, and you can make an absolute shitload of money. So I
yeah.
think these are the times definitely where self reflection can really matter.
I wanted to buy like a gold bracelet last year, like 2 years ago. And now I'm regretting I didn't because it's like 50% higher from when I wanted it.
Yeah, it is insane. It's also, I never thought I'd say this because personally, I don't know if you've ever ventured into it. I never touched Forex. I did believe in a
Higher.
lot of the discretionary stuff around equity trading and things like that, but I never really believed Forex trading worked. And ironically, I've known some good Forex traders recently make a ton of money just because of the opportunities have been insane because of Trump. That hasn't made me think that I'm going to venture into it anytime soon, just because that's a whole nother market. I can't really be asked to have that much on my plate. But there is, at least now, a lot of volatility where you can actually make really good opportunities in that market as well.
Yeah, when there's risk on the table and volatility, I'm not, I'm like, I believe that there's opportunity everywhere when there's risk on the table because most people are afraid of that risk and everybody's like takes positions that everybody else is saying, like everybody's making dumb decisions right now. And if you are there, if you are collected, you have system and you can pick it up, that money from the table that is being sent right now, then you are in a good position, but it takes a lot of courage.
Yeah. Do you think you should have an identity as a trader, or do you think you should just go wherever there are edges?
It depends on your capital. Like, let's say that it really depends on your capital, in my opinion. Like, if you have if you have like low six figures, something like that, and you are trying to, or low five figures or five figures in general, and if you are trying to do a bunch of things at the same time, I don't think that's going to work. But if you have like multi seven figures and you have opportunities here and there and you know how to quantify them, you have experience, intuition, and you can take them, great, because there's opportunities everywhere. Uh, but I don't know, man. To me, it has been about specialization. So that's all I can say.
That's fair. I think I have a similar view. I think I'll just add one more criteria, which would be experience level.
Yeah.
Obviously, you can beat that if you have seven figures and you just hire a ton of people to analyze different markets. But on a practical level, I've only recently, and this is coming into 5 years and a half of trading, felt comfortable taking on risks in varying markets. Right, like you've seen me explore into crypto, etc. Whereas before, I was very focused always just on one thing at a time. It was small caps, then it was futures while still trading a bit of small caps, and now it's primarily just futures and now also adding crypto. So I think over time you can add more markets when there is clear edge in place. So like for equities, same as you, I was adding some long positions as we're getting down further. Obviously, we're going to see if it's a Black Monday or not, but we'll see how that goes. But yeah, I think it's capital plus experience. If you're feeling comfortable at the 5 year, I don't really know what exact year it'd be, but probably 5 years plus is where I think you can then start to just move wherever the edge is because you just have enough general knowledge in most markets. But still, like even as I mentioned earlier, the Forex trade, technically I knew that was happening, but no, I just don't know really anything about Forex. So I didn't move into that. And I also didn't have someone I could rely on to kind of get me up to speed or that was already taking the trade, at least in real time. So I think those things are the main two factors.
Yeah, for sure. I think experience is very important. For example, right now, I'm in a bunch of protocols and different projects on crypto, farming airdrops. Like, for example, even today, there is this new decentralized, like perpetual exchange that is coming up, and I saw a bunch of uh, people with a lot of following on Twitter talking about it. And I went to their team on Twitter. I asked them for to test the platform and stuff like that. And those stuff, like I know I'm taking risk there, and I'm doing some funding arbitrage in their platform right now. I sent like money in there. All of those stuff, like I understand the risks, but I also understand the upside, and I can control and manage the risk. So I start to take way more positions than I usually had. But back in the day, I also didn't have much capital to just diversify like that. I had capital to do one strategy and to focus on that. And yeah, it depends really on your capital that you have and your experience with it, managing it, I think.
Yeah, totally fair. I think this kind
Yeah.
of leads into my last point, which was that every winning strategy normally exploits three things. There are more, obviously, but I think summed down, it's structural inefficiencies. So this is like bad pricing models where prices are misaligned to what fair value is. Info asymmetry, so knowing something first. That doesn't necessarily mean has to be insider knowledge, but it means necessarily you have some factor you think that's going to affect the market earlier than what other people are already weighing that on. So like as you saw, while everyone's speculating on Twitter that did Berkshire Hathaway had like some sort of information that other people didn't know, and that's why he was in so much cash. Personally, I don't believe so. Obviously, I think he has some of the best researchers, etc. But I think he was just positioned very well, knowing that at some point this was going to happen if tariffs played out. Because if you look at his timing, he was still 30 days early. That doesn't necessarily mean he perfectly timed it. If it was the day before or something, then it would be a bit more suspicious. So I think that's kind of the second one. And then the last one was kind of superior execution. So this one's just back in the day. I think it still applies nowadays. I'm not 100% sure, but mainly back in the day, if you had like closer service to the exchange, if you had faster computers, etc., that could execute more orders faster, then those sort of things where you can have a huge edge in, where you're making a very small amount on a huge volume, and then that kind of brings you your gains.
Yeah, definitely. I would ask, so, I would add there's some risk premium.
Oh yeah, true. That's very true. Yeah, I guess that'd be
Yeah.
the fourth one.
And that's about it. Everything that a small a small trader with a retail operation can do, in my opinion.
I agree. What one do you think is the easiest to exploit?
Risk premium. Start not easiest. It's not that it is easy to make money. It's going to be volatile and
Yeah, but out of the four though.
yeah, risk premium. Start with
Yeah,
that. It's what we do it right with momentum and stuff like that. And
totally
then
agree.
you start doing something else. Like you start going into inefficiencies. You see people that are trading at bad prices for whatever reason, and you start identifying those. And yeah, you go from there. But you need to specialize on something first.
Yeah, I definitely agree. I think people underplay like the power of risk premiums. Like obviously they're very simple. They don't make huge excess returns, but it's something that everyone can do and at least get their kind of way into it. And also, I don't know how correct this is necessary to say, but you can have a lot of liquidity in risk premiums and they won't completely fade. Like if a lot of retail traders start trading trend following, I wouldn't imagine that's going to disappear tomorrow. Obviously, that's within some sort of limits, but it's something that you don't have to be too worried about exposing your edge on it. Or do you not agree with that, Pedro?
No, I agree. There's a reason why it doesn't get like arbitrage the way, right? Because it's really hard to do and it has very high drawdowns and the sharp isn't that high. So at least this is my assumption. The big firms aren't like, oh, I have here a 0.5 sharp strategy to sell you. Like they want the high stuff. That's why they have a bunch of team of researchers in there. And so there's opportunity for the small traders to be exposed to those type of strategies. But it's going to be a wild ride.
Yeah, I definitely agree. And then I'd probably add, well, this doesn't necessarily fall into why it's a winning strategy, but I would fall into that when you do have a small amount of capital, try and take advantage of places where it's beneficial to have a small amount of capital. That's not always the case. I'm not saying you can't do a trend following approach on futures with a small amount of capital and still compound gains over time. But if you can, I think we've talked about it on many other episodes that, if you go into a space that doesn't have that much liquidity, but it's the right size for the amount of capital you have, you can make a lot more excess returns with that. Obviously, you're taking on more risk fundamentally, but it can be a very good place to quickly compound.
Yeah, definitely. I think you need to go where you are compensated to be at.
I like that. I think that's a nice way of putting it.
Yeah, where you are most compensated, and that's where you find more risk because the big players aren't willing to play there, and so you as a small trader, if you put enough work and understand the market dynamics there, you can compete with other smaller traders that are not as efficient as you are. So
yeah, completely.
So in my like I'm going to start this off like I'm not a macro expert, right? I don't claim to be, but at least I'm doing some long-term like capital management on my own side. And one of the things that I like to do is buy things on discounts, but discounts aren't just stuff that is going down. You have to have some assumption of value, but like markets are forward-looking machines, right? And everybody's positioned for these rates to be like the Armageddon of markets, whatever. Everybody's positioned with puts, shorts from the last couple of days, and I see too much eager positioning on the short side. I'm not saying that this will be like a long-lasting bottom, but I'm trying to think ahead, like into 2026, into later down this year, like there will be the midterms next year, which usually are more positive for markets because whatever administrations want to end on a positive note, to go to those elections on a positive note so that they can try to get the majority, even though that's low odds. Trump is using these tariffs as a mechanism to try and get better deals with other countries, also trying to refinance the debt by lowering markets and stuff like that. So there's a bunch of things that I'm trying to look forward in the market. And so I'm starting to scale back into the market on my long-term portfolios, both on equities and on crypto. And now this is not like I'm putting 10x leverage on my all accounts, right? I'm doing things like, imagine like 5% blocks every month, something like that, something strategic. Because also into the summer, I don't believe that we'll have a lot of action. Historically, the summers are slower and we are getting there. So the next few months, I think it will be stale, lost performance. And so I'm making my play into Q4 and into 2026. What do you think about the markets going forward?
To be honest, this is probably where I have the least amount of information. I've been never good at discretionary or macro trading, to be honest. But at least what I've seen is I've seen some very crazy takes. I've seen some people say that we're going to go into a 10-year long range on the markets. I've seen people saying that 10% yearly is going to be destroyed down to about 3% over the decade or so. I don't know if I believe all those. I personally think it's more of a positioning move that Trump's doing, but I do agree that it definitely hasn't been great for markets. At least from the news I've seen over the weekend, people have already started to negotiate with him on tariffs. So could be something that we bounce back on. And I think people are maybe emphasizing on it. The only person that shocked me, and I'm not calling him out saying that he's wrong. I think Lucas is an amazing trader. I just can't believe he took off all of his US asset positions. When I say Lucas, I'm referring to Short Bear. He has said that it's only like a median thing. He's not going to never touch US equities again, but he's unloaded a lot of his. And obviously, he's very well positioned for China. And that's his sort of bet at the moment. While that may play out in the short term, I think that could. At least for me, I'm treating it as a long term sort of game, at least for long term, like for SPY. So I try and just forget about all the money I put there. I keep, at least for my split, most of it is going to be high interest savings accounts and then SPY. I touch a bit of bonds as well, but it's only like a 60-40, so 60% in SPY, 40% like high interest savings or bonds that are getting like 5%, 4%. And that's just kind of how I'm playing it for the next, I don't know, 20 years, 30 years.
Yeah, definitely. Like I'm not trying to pretend that I'm a macro expert. I'm just saying that playing the man, like trying to understand the man that is in front of all of this, what he's trying to do, what's the next move, everybody's afraid. Are people wrong? Is everybody like that is positioned everyone is bearish, so afraid of everything? Are they right going into 2026? I'm not saying next month or next 2 months. Again, I'm willing to take drawdowns on this, but I don't think it's like the big Armageddon that they are saying. But that's me. What the hell do I know?
I guess we can look back. This is the good point of doing these podcasts. We can look back in 3 months or
Okay.
something
And
and see if we're completely wrong.
I'll be the first one to say that I was wrong.
Yeah, I guess we could see. I will say that people, when you, especially in these sort of stress periods, Twitter can be a great resource, but it can also be terrible during these times. Like the takes I've seen have just been so outlandish.
Yeah.
While they might be true, like if you say 100 things, maybe one thing will be true, but some of them just make no sense, at least to my understanding. At least over the long term, maybe over the next month, completely, we could definitely go down further. But over the next 5 years, I'd be pretty shocked. Especially when you like look at the drawdown compared to like COVID, this move has been, in my opinion, a huge overreaction. Like I've rarely seen NQ and ES downtrend like that, where my position, I don't think I took any heat on it. It was insane to watch. My positions entered, and I just the whole day I was just in money, making more money. It was just it was just insane.
And COVID was a real crisis. Like
Yeah.
we were getting all these videos from whatever, from these places, and nobody knew what was going on. Government was saying that we need to stay home. I'm saying like in March 2020, like it was a real crisis. And now we are getting this extreme reaction on a deal play. Like, okay, maybe again, I'm not a macro expert. I'm just saying that to say that this is an Armageddon and we're going to have another lost decade, maybe we have, whatever. I'm just saying that I'm willing to take risk the further down we go.
Actually, one thing I'll give myself a pat on the back for is I swear last or maybe the previous episode of this podcast, I was like, well, everyone should test their strategies over stress events because every 2 years there's normally one. And hey,
Yeah.
next 2 weeks you have a crazy stress event and the market just absolutely crashed. I will say that like that was the key thing for me was that I've been running my strategies for a while, but we haven't had an event like this for a good amount of time, and this showed me a lot of holes necessarily in my portfolio. But the hard thing was, and I've been thinking about this over the past week, is there's not many ways really for me to negate this. I just have to be a bit more careful on risk. Because luckily I was well positioned for this, and luckily I got the correct signals, or at least my strategies got a winning signal, right? But if they didn't, oh my god, man, I had 9 positions open out of like 10 strategies. It was a bit scary to see, and I had the feeling of like, do I override this? My only thing I had was that if I went into a serious drawdown, I would override a bit to lower some exposure. But apart from that, I was just gonna let it play out.
Yeah, definitely. Every like bear market, whatever, or bear market crash, whatever, like it teaches us something. And if we survive them, we gain more confidence. Like I've been through been through this, like I've been through 2020, 2018, 2022. Like I've been through all of them. Like I've never been through a 2008, for example.
Yeah.
So an experience like that would be something to watch if I survived it or not. But so far, I've survived it. I think I'm well positioned to survive the next one, and we'll see. We'll be here.
Yeah, I agree. I don't know because obviously you have like 2 years more experience than me, but at least from my feelings about it over the past years is that as you grow in capital, you kind of get the same feelings happen again. They're a bit more toned, but like this year, I've handled drawdowns before, right? And I've handled large volatility before. But because I have more money now at stake, I have more volatility happening. The numbers are bigger. It's you have to get climatized to it. It's like going up the mountain. You have to get used to that oxygen. At least that's how I feel about it. Did you feel completely calm during this period? I guess crypto wasn't as bad, so maybe it wasn't as bad of an experience for you. But it was wild to see, at least for me.
Yeah, definitely. Like you get more. It's weird. It doesn't affect me that much anymore. Yeah, I know. I'm not. I don't want to say it's nothing, but if you were with me, you wouldn't even notice that I'm in a drawdown. So I think you get used to it. It's experience. You know that. Like I've been through like I said, I've been through this many times. Like I've been through 2022. Like every altcoin was down 90%. Even Bitcoin was down 80% or more. Like I've been through them. I survived. Maybe I'll survive this one. So we keep going.
Yeah, I completely agree. Do you want to
Yeah.
move on to your last point then?
I think it is right about what we were just saying, like dealing with bad periods in markets. Like you have to, it's all about experience. I can teach you. I cannot put to the listener like what it is like to go through 80 and 90% drawdowns in the market. I'm not saying in your portfolio, in the market. I cannot put, and I cannot tell you that you have to go through it and you have to survive and gain confidence in yourself. And that is done through very careful risk management, good systems, and yeah, don't waste your bullets away because you're going to need them for the next leg that eventually comes.
Completely agree. It's one of those, like, I wouldn't say unteachable, but almost unteachable things around trading, where people ask you the question, how do you handle it? And I'm like, well, you kind of have to go through it. You have to
Yeah.
go through it. Obviously, we can give you tips and tricks of like how to position. Obviously, you know that you shouldn't be taking on too much risk, you shouldn't be taking on too much leverage, etc. But when you experience these moments, then you really understand why that lesson is so important, and you kind of stick to it a bit better.
Exactly. It's like you don't learn in books. It's like swimming. You don't learn swimming in books. You have to go into the waters, and here is the same.
Yeah, no, I agree. I'd also say, as one side point, um, no one, I've seen this mentality on Twitter sometimes, and personally, I don't think having outside incomes or side incomes to trading is ever a bad thing. I think it's always it's always plus EV, in my opinion. Whether that be you do a part-time job, whether you still have a full-time job, whether you sell some services, etc. Those have always been a key thing. If you can provide value in some way where someone is willing to exchange monetary value for it, then I think you should always do it next to trading. Trading does take up a lot of time, and don't get me wrong, you should always prioritize trading. But later on in the years, that time, depending on your approach, can narrow down of what extra things you need to do. So you can take up those side incomes to like basically add a padding to your trading, because you will get markets like this. And if you are, let's say it's your first year in trading and you only have a long strategy, this is gonna maybe be a while until you make like solid money again. Obviously, you can add maybe a short strategy and you can continue refining, but that's going to take time as well. So having side incomes in trading, I think, is completely logical. If you don't, it might actually even be a thing that's worth it.
I think this is the perfect point to end today's point. I've actually added just this to the next week's episode because I've all my trading career I've had always either a job, part-time job, or services, and
Yeah.
I cannot tell you how important that is. And so I think that's a good topic for next week.